Let's just take a quick look up here. On the top panel here, what you have is actually August, entry from August 13th. August 13th, okay? This is me on vacation. This is the newsletter I sent out from vacation. And, the main point here is all that's happened is we've come round trip. We've come round trip. Nothing else. I wouldn't call it anything better or worse. We'll take a look and you'll hear some, and you'll also understand where I'm going here. So let's just take a look at a new. And what you have is this past Friday, or yesterday, you saw non-farm payrolls probably as good as could have been expected. Right? In other words, if the Fed had their way and they wanted to hit a number, or if they wanted the statistic to come out pretty much as good as it could have been, it was probably yesterday. That didn't help financial markets. Right? It didn't help financial markets. And we're going to review that today, right? Because, there's nothing surprising here. Again, this has not been a complicated market to understand at all. This has not been a complicated market to understand. Thumbnail should have said in the newsletter, stocks for show, bonds for dough. And what you have here is the S&P 500. And what you basically have, as I've stated, and this isn't about I told you so. Right? This is really to get us on track so that people are not confused. You can see the graph. This is S&P 500 for the past 3 months. And this is this over on the far right-hand side, 392.24. Almost, and you can see no better than when? The end of July. We've come a month for no progress. And you can see still better than the end these days here of the end of June. And you can remember I have a short out there talking about Swiss National Bank, days before triple witching expiry of options markets and futures contracts. Right? They didn't care. Right? Everyone in the world is looking at the technical setup of the market, knowing that buybacks are coming back, etc., knowing that, it's the end of the quarter, which is an important date, all of that stuff. Swiss National Bank, they didn't give a lick. They were like, look, we're going to think about defending our currency, and guess what? We're going to sell stocks, and guess what stocks they own truckloads of? NASDAQ. And this threw us off the track, if you will. If you go back to the newsletter, you would have seen in the end of June that, in fact, I was saying, hey, this is awfully far down. And so what ends up happening, we took this detour here and had chop around, but ultimately back higher. Now, that's what the headlines are going to always say, right? Because this is, stocks for show, right? They're the ones that get the attention. Jay's Corner, the mantra, stocks for show, bonds for dough. Let's just take a look. So TLT is the ticker of the 30-year Treasury U.S. government bond. Right? The longest dated, most sensitive to interest rates. And look what happened. That in the same way, one of the things that I was saying was that the purple line was stable-ish, allowing the happy talk to proceed. It allowed the happy talk of stock. Oh, earnings, have outperformed. Yeah. Except for around here, now we're up here, right? In other words, this purple line was at the height, right, during this period. The Federal Reserve sent out their troops, the lieutenants, to the podiums, a point I've made here on broadcast and in the newsletter, saying, hey, you know what? The Fed has sent up its lieutenants to say, we are not done hiking interest rates. What is this narrative that I'm seeing on CNBC and Barron's, Kiplinger's, Wall Street Journal, New York Times, Washington Post, etc.? It doesn't look right. And what happened? Purple. Down. And not coincidentally, and slightly behind, stocks notably down. This should not be a surprise to anyone here on Jay's Corner. Should be absolutely zero surprise. Right? Because of the fact that, what do we have? Denominator up, right? This NPV down. That's every risky asset, period. Right? That also includes the value of your house, right? Mortgage rates higher, the bids start to dry up. Same thing. Same thing. So nothing interesting here. You'll see even more dramatically as we change time frames. So let's close this down here and let's take another look. This was over the past 3 months, and you can see how dramatic it has been this year. If anything, and the reason that portfolios on a global basis are down this greatly, your consolidated basis, we're going to get to the targeted date funds in just a few moments. The long bond is down 26% this year. Worse than the stock market. So people have been thinking, oh, well, you go to bonds for stability. No, not necessarily. Right? It's not about whether or not the U.S. government can pay back its obligations. Right? We kind of, in the United States, we have to live with that presumption, right? Because if they can't pay back their obligations, we've got such a much bigger set of problems that, basically your entire balance to your bank account is dust. But my point here is that, this is when you buy a bond, you're not buying it and holding it to maturity. It is just the price or the NPV as stated here on this diagram or this formula. And you can see that the purple line here is even worse than the blue line. Blue line being the S&P 500. Well, now you can also understand this next line that's going to be added. This next line then being QQQ, which is the NASDAQ. Very unfortunate choice of colors by me. And there it is. That you can see that with some error, but not that much, right? Not that much, that the purple line and the red line almost smack on top of each other over the full year. You can see it there over on the far right-hand side of your screen. Minus 25%. I've pointed this out on the newsletter, right? Which is to basically to tell you, to say, look, the reason is because of, as we've said, well, the NASDAQ is the one where this last term all the way on the right-hand side of your screen is the most sensitive for NASDAQ. Why? Because the cash flows, the profits, you're buying NASDAQ stocks, generally speaking, not every single line item, but in general, Because why? On a future return, where the future is way out in the distance, right? Metaverse. Okay? It is not General Mills. Nothing's wrong with General Mills. You know, people buy Cheerios all the time, right? Though that money is today, right? In other words, it's it's like C1. But a NASDAQ stock, a high flyer, or a stock where you're thinking, okay, well, here's some like newfangled idea. It's going to occur in, 25 years, and you're buying from now for the long run. Well, yeah, that's this last term over here. And you can see by the graph, you can see here by the formula, makes complete sense. By the way, now you can explain what has happened over the last 2 decades. Are both stable and lower? Both. I'm going to keep saying that. It's not just the level, but it's the fact that it was that stable. Because now you could just go, look, in 5 years, in 3 years, etc., I'm not getting better return on my cash. So as a result, I've got nothing else to buy. Tina, there is nothing else. No alternative. What do? Buy long-dated stocks. What are those? NASDAQ. And now you get it. Now you come full circle. Not full circle, however. Not full circle. And I've called this, and now I'm going to move as I've said, I've moved us from the middle of the fifth to the bottom of the fifth. We're getting close to the middle of the sixth. Because at this point, the issue is that, let's call it Jay's Rib Shack. Remember, I use Jay's Rib Shack because I'm not making a particular recommendation today. Today's not financial advice. Jay's Rib Shack here. What if I need the money to pay for expenses and I need to borrow money to pay for expenses? If my cost of borrowing increases now, and I therefore cannot expand as planned, now the feedback loop will go back now to the numerator. You have seen this in the press, which is whether or not earnings projections, which is the numerator, correctly reflect all of the incredible crossfire, a lot of which is not understood to begin with, because people don't understand this. Don't understand the fact that, oh yeah, by the way, bonds can be risky stuff. Take a look at the graph, minus 26% for the US long bond. The focus on the numerator and the effect on earnings. Well, we don't necessarily have that yet. I suspect the answer to that is still no. And especially alarming on top of that are the other graphs that are mentioned here on the channel. For example, and I'll bring up another tab here. And here it is, as I've said to you, and I said last week during the 5-hour stream, 5 hours, I was, and don't get wound up. I took the winnings from last week, took the money out, put it into the bank, and here's a fraction of $6.60. That's my normal stake level for entertainment purposes, as I'm, multitasking, to be candid with you. And you can see, by the way, we're going to get to that in a moment. But let's just take a look here, and what you have here is currency. You'll hear when you hear an earnings report, oh, well, blah, 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 foreign currency exchange, this effect, and then everyone blows it off, which I find stunning. This is the other day, by the way. This is the other day. Graphs aren't supposed to look like this in a day. They're not. Yeah, your vacation in Rome is cheaper today. That is true. Ford, I've used this example in other videos. Ford, however, right? Their costs are in dollars. Now, the Ford in Rome, they only collect euro, which is now worth much less than it was 12 months ago. And now you can see the feedback loop to the numerator. Right? Because of the fact that the foreign exchange has changed to that degree. You know, lots of times when you're in the popular press, this gets blown off. You'll hear something and just say, oh, well, blah, 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 no big deal. You know, temporary blip. Yeah, we're 20% lower. So now the C here is in dollars, right? Because your earnings per share on Ford. Nothing's wrong with Ford, the company. I think that, you know, people from Ford and generally spoken in corporate America, Ford is given high marks. No problem. Doesn't matter. Does not matter in the scheme of this, right? They're not controlling foreign exchange. I promise you. No one's calling up the Ford CEO to say, hey, can you influence foreign exchange? No one. So what ends up happening is now this is their euro revenue is then translated into US dollar, which is now lower. The question is whether or not existing risky assets currently reflect that. There's a reason I'm not calling this the 7th or 8th inning. This is not resolved here at all. Because over here is a conflict. Over here is a squeeze on energy. Over here is the idea, oh, Nord Stream is, maintenance problem. Oh, yeah. If you believe that's a maintenance problem, I've got some swampland for you. That is, a lever, period. That's it. That's how it's got to be understood. Right? That's a geopolitical lever. If you don't have energy over there and you end up having to shut off the lights in Frankfurt because you don't have access to natural gas, and this continues to go up and down, the issue is here, the feedback loop, as I said to persons last week, is that the relationship between that and the bond market is, they are very related to each other. Very related to each other. So now where are we? We're here. This is the S&P 500. You can remember that there was the debate about, the coffee cup. Right? Market isn't here to prove or to justify or to say, okay, you're Mr. Smith, you're the smartest person on the planet. Not here for that. It's here to discover the clearing price of this glasses case. That's it. I've pointed out the fact that there are these congestion zones. Oh, and up here I said, we had exceeded the congestion zone by some degree here over this long period. But now, what did we have? We had bonds straight. Now you can see what happened. Bonds back down. Stocks back down. Resting in this now very convoluted congestion zone. Very. These are not small. You can look at the far right-hand side. This is 3,900 to 4,400. The NASDAQ has dropped 12% from the high. from the recent high of 2 weeks ago. Okay, so we're talking about dramatically move because of the fact of what? Because you now know that it's always been stocks for show, bonds for dough. It's always been that way. It's been blown off as a result of the stability and persistently lower R. That's it. Let's keep going. I realize that, am I going to run out of time? Probably. Okay, and so you can see here, this is the 10-year note. This is now the 10-year note. And you could see that it was higher and then dramatically lower. So let's just expand the time frames here. Interest rates this much lower, right? The Fed lieutenants start taking the podium. Fed Chairman Powell says, we are going to have pain for businesses and households. They've clearly stated it. And it's okay. We can the market is going to be out there saying, we're going to outguess them, or they're going to be forced to this, that, or the other. It's pretty funny, and the point was made, and it's correct, right? So when the market is straight up, right? When the market was straight up, you know what narrative you would hear? You'd heard the narrative of, right? Straight up. Then, everyone said, don't fight the Fed. Oh, but now they switched. It's like, oh, the Fed is going to be forced to X. And this is my point here, right? And this is absolutely having to do with, the lattice, right? It absolutely has to do with the lattice. Because of and by the lattice for newcomers, for persons who are, new here, right? Yeah. Right? In other words, what I'm saying is door swings both ways. And yet what you have in the narrative in the financial press is, okay, when it fits my narrative where I get to talk about the numerator, then it's don't fight the Fed. Okay, wait a minute. You're detracting away from my attention on the numerator? Okay. Well, now the Fed is gonna listen to the market. Wait a minute. They retrofitted the narrative to base on kind of their belief. That is dangerous stuff. Real dangerous. And so you can understand, I'm sitting there, I don't have a very good existence, right? Because I can see this contradiction as it's occurring, as it's being, crosses my eyeballs, or, I'm sitting there listening to the popular press or reading the financial press and seeing these type of narratives. Oh, we've switched our logic now, have we? To fit what we wanted to hear. To fit the happy talk, to fit, by the way, to fit the bar talk about the fact that you believe that insurance didn't pay you anything. Okay. So in a broader sense, you can see the point of Jay's corner, right? Hopefully you can. Right? These aren't like similar by coincidence. My explanations are not similar by coincidence. They are similar intentionally. Because only then can you separate the signal from the noise. There's a ton of noise. We're going to accept that. That's our planet. This has made things, of course, difficult. Right? The result-oriented society we live in has made it difficult. Right. And people subscribers to the newsletter have seen this before. Right. And I'm just using it as a prototype. There's nothing wrong with Vanguard, the company. There's nothing wrong with the way they built this portfolio per se. It is very much along the lines that you would have expect from modern portfolio theory. Go ahead and Google it. right? Absolutely expected. Still, so best in the world, minus 17.11 year to date. And if you think that they were just singularly wrong, in the same neighborhood of vendors, meaning top of the class, right? Undisputed. This is BlackRock, minus 17.44. You can see how close. 0.33, and that's wider than it has been. So again, on $100, this is not $33 difference. This is 33 cents on $100. That's how close. Let's swerve here. I'm going to stop for 2 seconds. Let's take a look at this. So this is the portfolio, and it's there. You can go. This is publicly available information, right? They do a nice job of revealing. Let's look at portfolio composition. And in here, what do you see? You can see it. They've got these nice pie charts and colors, right? Total stock market, fine. 48%, fine. International Stock Index Fund, 31%. Total bond, 16%. International bond, 16%. In other words, 48% stocks, 32% international stocks, 22% bond market. It explains. Now you can see what has happened. You can absolutely explain 17.7 minus 17%. How? Yeah. You got it. Of course you do. Your date? Ding. So now this makes entire sense. It also gives you the key to understanding how you may have deviated. Right? And there's a reason I'm swerving here and talking a little bit more slowly. Let's go over here. It looks like a game of pure randomness. And really what's going on now in this game, the way that this game is now played is by simulation and by quantitative analysis with the additional layer of game theory, which is way different than a bouncing ball and a spinning wheel. In other words, we see my cards. We're assessing our probability of success, low. That drives your action full. In the same way, we are looking at this. Of course we are. We've assessed 610. We can't get to a positive place where we're getting chips. We fold. Fold. And you can see what has happened. What I've been talking for 30 minutes. I've been talking for 40 minutes. I have barely played. That also not a coincidence. Right? So in other words, the perception here is what? The perception is that, oh, poker's this high speed, glamorous thing. Like financial markets, something glamorous and glorious. I bought a meme stock. There's nothing glamorous about this at all, right? Well, of course, there's nothing glamorous about it because you see me here on, Jay's Quarter, right? There's nothing glamorous here. Nothing. Zero. You're getting the highlight. You're getting the highlight if you see some, if you flip on TV and you see some 30-minute show. You're seeing a TV show. You're not seeing the grind every moment. Right? Every moment thinking through the probabilities, thinking basically through this grid. And you can see here, right? At some point in time, is there risk involved? You can see this hand. Okay. Because it's a perfect example in that particular hand. The person who lost did nothing wrong. But there was still randomness involved. And you're still at the red arrow. Oh, you mean just like financial markets every day or depending on your time frame? You bet ya. It looks and feels the same, and there's a reason. Exercise is largely or very much related in the sense that that is how you think through where you are, what the outcomes could be, and then how does that affect you, the audience person. And that is shaped by your circumstance and point in time in your life and point in time in your personal circumstance, which also, by the way, includes your DNA. And in fact, if you call it one determinant, again, you can now also understand the fact that there's no coincidence that for retirement planning, step number one is this, is understand Medicare. Why? Because the scenarios here are that much worse in certain, or the payouts, the outcomes of our lattice that I showed you, right? The lattice is that much worse. The down, if you don't understand what is going on and you have some insurance and you have some health situation which is going to require very expensive healthcare services, you're going to keep going down. Let's continue. So what we have here is that basically you can see a BlackRock life path. And now you can see its link here. And now we're to the bottom panel. If you look below the spreadsheet, what I did is I clipped out a page. People that say, okay, well, what are you actually doing commercially? This is basically in a nutshell. There's a free panel, by the way. There's your public service announcement, right? If you're going to come say, Jay, I already get all of that. I understand everything you say. Just hook me up with finding me. I'm 35 years old. Can I get the Affordable Care Act and the tax subsidy and drive down my premium because I don't make that much money? I have a young family. I've got 2 young children. We don't have much money. We need this money for daycare. We need this for some other priority purposes. We're 35. We're Mr. and Mrs. Perfect, but we have young children. That's all fine. That's all zero. That's fine, right? Medicaid, zero. No problem, right? All fees, no matter what, waived for Medicaid. The best place to get the inside information is the paid Substack, which is $30 a year. You can see the web, you can see the address. That is what I've been showing you here on your screen. Going through, this is actually the free version, etc. But there are more curated sets of information. In the middle, 250 is your test drive for a particular situation. This one is, well, let me just first say, these 2 panels on the right, the middle and the right, are at the wrong price, of which I'm going to address in 2023, right? There's no way that January 1st, that these numbers are not, they're not going to be the same. I'll just leave it with you there. I'm going to be telling you this on the Substack. I'm saying it to you for the first time here. What happens here on 250 is that it's a one-time analysis, and you can choose a silo, and I'll address it. Very nice married couple in Ann Arbor, Michigan. Right, hands a stack of insurance products. Here's what you have. Here's what you think. What do you think? They're going to get a set of answers, which is going to easily net them a difference one way or the other, either in lower premium or superior setup, given what they've told me. If it's worth 20 times the fee, I'm too low. I'm not even talking about the fact that they will be enlightened to, what is actually going on today. That said, it's not as if I always know that that's going to be the case. In other words, there's going to be a disconnect between how much I charge, how much work it takes, and then the end result. I can accept that, right? That's just my commercial risk. Literally, and I've told this to people, directly, which is, this is largely to shoo away the wild goose chase inquiry. Jay, will you, build me a new house for $0? That kind of stuff. The one on the right is me in full flight, and, in full flight, which is using all of the collaborated set of skills, background, information on every topic to get you to this spreadsheet. One that you and I will share on every item. And the most importantly, for the ultimate goal, which is this green. Because unlike most of the messages that you're getting, right? Oh, avoid annuities, because the 10 things that they don't tell you about annuities to avoid. What your life insurance agent will never tell you. This, that, or the other. Okay, so now we're going to have to swerve here. So we're here on Poker Central because this is a superior hand. I know it. And so I'm going to accept the randomness of bad cards to start, but that doesn't, and now you can see I'm being challenged. And don't get me wrong, this stream can end on this hand. So Ace Jack is an excellent hand in Pokerland, no question. And I'm certainly not folding for this difference. So let's just see. Okay. So now you can see all we've done is move nodes. That's it. My likelihood is declined, but a 10 or an ace or another club. So I'm going to not risk money and watch what he does. And now you can see what I'm saying, which is that this is now we're playing against the opponent. So what he has done is he has bet 7.65 with a denominator of 15.33, 50%. I have an awfully strong hand, but I'm going to fold here, largely because I'm going to try to keep the stream going, which is wrong, right? I mean, in other words, the poker professionals of the world are going to say, I've been disconnected, no idea why. They didn't like the way that I played that hand, so they disconnected me, I guess. And you can see what ends up happening, right? In other words, to give you an idea on that hand, that the game theory optimal decision would have been different there. I'm aware of it. Okay? And now we're going back to, now I'm glad, now you understand why I have this on the stream. Right? Because in a way, it's very similar to deviating from here. There's a reason that the stable here amongst us, and by stable amongst us, which is feedback loop to here, this person, let's just say, is 67. Because now, if this person hadn't battened down the hatches, this 100, which sat in a qualified fund, is now minus 17, which makes this number 82. The issue is, in order to get back to 100, what's going to have to, in order to get back to 100, let's just cuff it, right? And just call that 80, right? You need the market to go, you need your portfolio to go up from 80 to 100. That's 25%. However, if you had gone back to January, and I'm not saying that this is always going to have been the case, right? In other words, that household one has $5 million. Household number one is in no real interest of losing money from here. Why? For what? Right? I mean, their life is no better, but it's much worse on the other side. Right? So, I mean, that person looks through this list and goes, you know what? I now understand stocks for show, bonds for dough. Why am I accepting this risk over here on this item here that no one else understands? You can see. Just take a look over 2 years. This is no better. This level here, right? NASDAQ. You're no better than when? The end of 2020. Today. So you can see this person here, if this number is $6 million, $5 million, I think I said, right? They're like, pass. We don't need this. The person with $50,000 as the entire amount for their name, everything else the same. $50,000, living check to check. Guess what? They may have no choice but to accept the risk. Depending on the household, that can be the case. Right? In other words, everything I've said here in Jay's corner is all the same. You can see here, we're going to switch back to poker here for just a moment, and this is kind of why I did it this way. We did it this way intentionally. So you really have a 7? So I can certainly lose to 2 hearts or a 7. This is a problem. This is a very... So even if I thought that I was ahead in the past, the situation changed. Because while this 2 looks innocent, the problem is it's a heart. So at this point in time, he raised. He may have 2 other hearts, making a 3rd heart a flush. I've lost. So while it was probable I was ahead after the 4th card, it's probable I'm behind now on the 5th. So I'm going to check. I'm not going to risk any more. So yeah. So, and then, even then, something else off the grid. They're related. Absolutely. So now back to this. $50,000. Now this person has a totally different thought process then. Right? They may have had to go ahead with the risk and accept the outcome of the best of class. But they needed to have known how the inside worked. And how these pieces fit together. That's the far right column. That's the far right column. Oh, yeah, and by the way, we're going to get to it now. So that's it for financial markets. 50. I knew it was going to be most. Couple points about Medicare. Here it is. This Bob Powell sent this to me. Gave me the heads up. I don't read the Wall Street Journal too much. Yeah. So, yes, I did notice this. The Medicare commercials have toned down in their aggressiveness. Subtly, but certainly. Okay? That doesn't mean the number of Medicare commercials is going to decline. Nah. No chances of that. But what you have is the idea that they're getting scrutinized, I'm sure. And they have subtly changed. Coming up into 2023, in just a month, I'm going to be forced to record every phone call when discussing Medicare options with people. As most people know, I generally have things on Zoom. Those are now going to have to be recorded. They're going to all be recorded. It's because let's just say that there are some things, it's to combat elder abuse, which is understandable. I don't have a problem with the recording. I've never had a problem with the recording, to be candid with you. There's a reason that I like email, because it's a clear trail of what is said, of which I'm just going to refer to. Remember the email from date X. It's not because I don't like to talk to you. It's because so that we don't forget, so that we don't lose track of the issues, so that it's very clear, so that I can just say, remember this. If you didn't completely understand, read it 10 times. We don't have to, and then keep asking questions. No problem. So I don't find a problem with these new regulations. You can also see over here, I'm going to shut this. I'm going to turn off the table. That also means it's going to be Medicare, enrollment, Medicare seminar season. Right? There are my dates there. In the Saginaw location, it's going to be up here at Horizons Conference Center on October 17th. That's going to be a Monday. On Sunday, October 2nd, even before then, is going to be a live webinar here for paid subscribers only. Meaning that if you remember over here on the left-hand column, there's a website. The only place to see it, even if you can't join us live, you can see us on this website. Only if you're a paid subscriber. Okay? I'll have at that time though, I will be able to discuss the plans, the features, in a surveyed way, right? What I'm going to do is I'm going to survey the market. I doubt that we're going to have Medicare premiums, updated Medicare premiums at that point. But all of that is coming up. It's going to be already October. I've been pointing and clicking to make sure that all of our, setups with all the carriers are going to be, established, which happens every year. Okay. Last point here. One more point over here, which is that on the Maximize Your Medicare channel, tomorrow there's going to be a new video, which is going to review my conversation with Art Lewis. And during that conversation, I cut in and, post some things to keep us on track so you understand what we're actually going through. Actually, I watched it this morning. That's why, I'm here at the computer, at the lovely hour of 4 a.m. this morning. I turned on the computer to review that. It's taking 3 to 4 hours to create the video, to render the video after the editing. It's like crazy. There's a reason that I'm, migrating to streams just for ease of production for everyone and speed for yourselves. Did I ask you to like? I told you how bad I am at marketing. I didn't ask you to like or subscribe. Last point, and we're up against it right now. So over here, you can see that depending on what happened here, and I just changed the number. I didn't change anybody's health yet. Right? I just changed somebody's number. That's it. And this is, of course, a high number for most people, but a number that you can see is 500,000. Right? And the same, you can have that person with his unlucky brother with 50,000. A very different setup here on these columns, on each row. So the idea that you would take the same approach towards any one of these rows compared to anyone else is weird. And weird is, I don't even know what the right terminology is. I can't recommend that. Which is another way of saying never say never, right? Because, okay, never this, never that. Okay, well, so you're going to tell me it's the same for the person at 5 million versus the person at 50,000. That's what you're going to tell me now. Didn't stop this person. I don't know what to tell you. There's a reason I'm this aggravated at certain points in time. There's a reason that I'm out here, saying this, that, and the other. This specifically, with this much aggravation. Why I never take Social Security at 65. Why I never would choose Medicare Advantage. Let's end the stream now before I get even more upset.
On this edition of You Must Be Kidding Me, we've got...
Hopefully you like today's video. Like, subscribe. Never say never.